Hello. We will be covering Chapter 3 and 4 in this, Chapter 3 in this session, and then we'll talk about Chapter 4. I'm hoping that you were able to grasp some of the really important concepts that we covered in Chapters 1 and 2 about journals, about journal entry, about the nature of accounting and what it's used for, and the various different types of transactions that you'll have to learn to interpret and journalize and ultimately record and post. Today, we want to expand on that knowledge and talk about the adjusting process. Now remember, we are working with corporations in this particular course, and as a result of that, some of the terms that relate are going to be very specific to corporate financial statements. However, the basis of accounting spreads beyond just corporate financial accounting, but we want to take up a little time to talk about some fundamental concepts that I think will make this process of recording transaction make much more sense. And we talked about GAAP accounting, again, the rules-based accounting that tells us what to do, how to do it, and when to do it. One of the concepts and that I think are important for you to understand is the accrual and cash basis of accounting. What they mean and what they mean to you, and how they apply to the various transactions that you will be recording over the term of this 9 weeks. Accrual-based accounting is under GAAP. It is a GAAP-approved method of accounting, and cash basis is not. So we want to talk about both of them, and we want to talk about why one was used over the other and what they mean. Accruals allows you to present your financial information based on the assumption that you're going to recognize revenues when you earn them, and you're going to recognize your expenses as they've been incurred. We're not concerned about when cash is received or when cash is paid out. It is not a determinant of whether or not the entry is recorded. The basis upon which all entries are recorded is the recognition of earnings, the earnings process. Did we complete the earnings process? If the answer is yes, we recognize revenue. We don't care if the cash is received at that point. The same is true when we actually receive cash from a client and we have not performed the service. The question then becomes, did we earn the money? And the answer is no. Accrual-based accounting requires us to record the cash, but we do not recognize the revenue. We have an obligation. So the accrual-based accounting is going to be recognition of revenues when earned in the period that they've earned it. So cash may be received from a customer or may not, but it doesn't matter because we're going to recognize the revenue because we've earned it. Now, we want to record the expenses when they have been incurred, not necessarily when cash is paid out. Therefore, it's the proper matching of revenues in the time period of revenues is going to be important. So we're going to be matching our revenues and our expenses in the proper period. We're not concerned about cash going out or cash coming in because that's not going to be the determining factor whether or not we record it. If we receive cash at the same time we've earned it, that's fine. But not always the case is when we earn money and we receive cash at the same time. It doesn't always work that way. Sometimes cash comes months later. Sometimes it comes weeks later. Sometimes cash comes first and the recognition or the actual performance of the job comes last. What do you do then? These are the kind of questions that you'll need to be able to have answers to because it's going to really affect the timing and the accounts that you choose when you're posting transactions. Cash basis is going to be recording transactions when cash is received or cash is paid out. Cash basis is not GAAP approved and it is not used for external financial reporting. Very, very important. Revenue recognition rules is what I've been talking about for, I think, the past 2 chapters. When do we recognize revenue? We recognize revenue when the service has been performed, when you deliver the product or service to the customer. So it is called the recognition of revenue. When we recognize revenue is when we have earned the revenue. Expense recognition principle, again, is the matching principle because we're going to be matching that expense with the revenue it generates in the same period. Very important to match it with the revenues, but in the same period. Very, very important. Adjusting process. And again, we've recorded transactions. And we have posted those transactions to the various accounts using a T account in this case. Then we took all of those postings and we transferred it to our trial balance. And again, this is a listing of accounts and their balances in debit credit format, making certain that the debits equal the credits. So now we have to adjust. There are various accounts that have to adjust. Not all accounts will require adjustment. There are some that will not require change. But for those accounts that require changes and adjustments, we're going to have to make certain that it generally falls under these categories. Some expenses have not been recorded, and we have to recognize those. Some revenues have been incurred or expenses have been incurred, and then we'd have to record that because of a passage of time. Some revenues expenses may not be recorded at the end of the period. We have to record those. So there are various transactions that have occurred between the time that you prepare your trial balance and the time that you have to prepare your financial statements. Those adjusting entries have to adjust various accounts to ensure that the accuracy of the account balances remains intact. So analysis of studying accounts for period ends is the adjusting process. We are making certain that every account on our trial balance are properly reflecting the activity for that period of time. That's the adjusting process. So the different types of accounts that require adjustments: accruals, deferrals. Deferrals are going to be, again, if you were to provide a service to a client, but before you provide the service, they actually paid you cash. So you increase your cash by $1,000, and then you have to increase this liability because you have an obligation to provide the service. Well, over time, you provided the service. So now you have to adjust it. That's a deferral. Accruals could be you've actually have received benefit from your employees. They've actually earned their work. They did the work for you, but you haven't recorded the transaction. That's an accrual. We have to accrue the use of wages from our employees, although we have yet to pay them. So accruals and deferrals are going to be the major categories for adjustments. And again, accrual happens when a revenue's been earned or expenses been incurred but have not been recorded. Plain and simple. Very, very basic. Don't get overly overwhelmed with this type of word called accrual because it's extremely easy to understand. Same is true with the deferral. As I told you before, you actually received the money. You didn't do the work. That means you have to push off, defer the recognition of revenue until you actually do the work, right? So that's a deferral. And again, you will see both of these types of transactions in your project, and you'll also see them again in your homework assignments over the course of the next 8 weeks. Depreciation, again, if you buy an asset, like a piece of furniture, for example, or a building, that asset is going to be helping you generate revenues, but it's going to generate revenues over a period of years. So you have to properly match the cost or allocate that cost of that asset over the periods, in this case years, that it will be generating revenue. That's the matching principle, and you do that through depreciation expense. Now, we don't have to worry about land because land does not have a finite life. And because it does not have a finite life, we cannot depreciate it. We do not depreciate it. We just let it sit on our balance sheet. But if land value does diminish because of some natural disaster, we can adjust the life or we can adjust down that asset value. But in the end, generally speaking, land does not depreciate. And we do not record any depreciation expense for land, but other assets, long-lived assets, we do. So again, adjusting entry is going to be just like any other entry. We're going to have to make certain that we record a depreciation expense, and we have to record the opposite, which is going to be accumulated depreciation. And again, that accumulated depreciation, which is the credit, is going to be offsetting the asset, which gives us a book value, a net book value of that asset. So at any time, we will always know the value of that asset, that long-lived asset. And again, here, this is just giving you some titles, and it's very, very important to see. Again, land is a fixed asset, building, store, equipment. But the corresponding contra account, the contra, which is an offsetting asset account, is going to be called accumulated depreciation, the buildings, accumulated depreciation, store, equipment, etc. Again, what I mentioned before, the asset value and subtracting out the accumulated depreciation is going to give you the book value. And again, the book value is what's going to be showing on your balance sheet, and it gives you that value, what it is valued at the point in time the balance sheet is prepared. So after we record all our adjusting entries, we got to recompute those balances. We now have an adjusted trial balance, and this is the report that we'll be using to prepare our financial statements, our income statement, our balance sheet, and our statement of stockholders' equity or statement of owner's equity, financial statement. In this particular chapter, we're talking about vertical analysis. Again, horizontal analysis is going to be talking about side to side, year to year type of analysis, ratios, and that sort of thing. Vertical is going to be top-down approach. It's going to be taking assets and dividing it into total assets and beginning to use some kind of ratios from top to bottom. And again, all of these ratios provide you information on your organization that has no necessarily barrier to a specific industry. So you can take these ratios and compare it to a company very much the same, but maybe larger or smaller, but the ratios kind of equate them, making them easier to compare the differences and the relationships among them to assess whether or not the organization is on the right track, or the organization doing better than the average or doing worse than the average, and why. Again, I think this chapter is going to be very, very practical, but important note, it is very critical that you understand the nature of what the transactions that we're performing, because when we're putting this all together, it's not going to make a lot of sense if you're not able to see what we're doing and why we're doing it. We record our transactions using the accrual basis of accounting, using our rules of accounting and saying that this is the transaction to be recorded based on the information provided. We're going to transfer those transactions to the accounts, which are our ledger accounts, get our ending balances, compute our ending balances. Then we're going to transfer it to our unadjusted trial balance, making certain that our trial balance debits equals our credits. Then for various accounts, or for accruals and for deferrals, we're going to be recording our adjusting entries. We're going to then compute or recalculate our adjusted trial balance, in which case then we have everything we need to close our books and prepare financial statements. Thank you very much for listening, and I will talk to you in the next chapter.